What types of bonds are there? The most important types explained simply. I am especially delighted today to have Mr. Helge Müller with me. He is the founder and CEO of the Swiss asset management companies Genf Invest, and he is a recognized bond expert. So when it comes to bonds in Switzerland, it's Helge Müller. With him, you can be sure you're meeting the right person who can explain everything, absolutely everything about bonds.
Caputo and Partners, SwissBankingLawyers.com. We fight for your money.
What are the various different types of financial bonds that exist?
Yes, you can distinguish between different categories. The first, from the issuer's perspective, is this. Who is borrowing the money? Because with a bond, someone borrows money and the investors receive a fixed interest rate in return. And here you can first say that there are government bonds, meaning debt securities issued by states. And in that case, it's the state itself that is borrowing money. This can either be the central government, individual municipalities, or also federal states or cantons that borrow money and issue bonds, pay a fixed interest rate and repay the money. The same applies to companies. They also borrow money and likewise provide the guarantee framework of interest payments and repayment. So the difference here is on the part of the issuer, what kind of security do I get? With the state, it's essentially the trust that the state will repay the money. It's actually very difficult to take real action against them. In some situations, attempts have been made to do so.
So with top corporate bonds, you're on the safe side. Is that a fair statement?
Yes, you can say that. Well, I would say it's more tangible in that sense. If a company doesn't pay its interest, then as a bondholder, I can take over the company. And in that respect, I can see, for example, whether the company is making profits and how much collateral there is. So that's the first important distinction. And then, of course, with companies, there's also the important distinction between large corporations in the investment grade sector and so-called high yield bonds. These are smaller companies that offer higher interest rates. They're also called junk bonds. They're called junk bonds because in the past, this category consisted exclusively of large companies that suddenly ran into trouble. A well-known example is General Motors, which in the 2000 SSO more than 15 years ago ran into major problems and then went bankrupt in 2008. That's where the name comes from, but today it's often smaller companies. Nevertheless, they don't have the same level of security as a major player that earns billions in profits. For example, Berkshire Hathaway also issues bonds. A company that has 300 billion in the bank, of course, offers greater security than a young company. But even there are very attractive deals. And of course, there are also smaller companies that are quite solid.
Then there are convertible bonds, right? Those are interesting too. Convertible bonds, that's what they're called.
Convertible bonds are really fascinating asset class. I think there are hardly any other asset classes that meet the needs of private investors, of frequent investors, as well as this one does. Because what do private investors and other investors want? They want to participate in the stock market when it goes up, but they don't want to be involved when it goes down. And everyone struggles with the idea of timing. It's difficult to sell at the right moment because prices fluctuate, sometimes really dropping. With convertible bonds, the mechanism works like this. Just like with regular bonds, I receive a fixed interest payment every year, and at the end of the term, I get my money back. Convertible bonds also have an additional component. Additionally, I can also choose to take the stock instead of the bond, but not at the price when the convertible bond matures, rather at a fixed price that was already determined when the bond was issued. Usually, at the time the bond is issued, this is a premium of 20 to 40%. The crucial point, let me give you a real-world example. This week, a new convertible bond from Fresenius was issued. The stock is currently trading at just over 40 euros, and the convertible bond gives you the option to convert at a price just under 60. So with a premium that is quite significant. But here's the crucial point. If the underlying bond of the company genuinely performs exceptionally well and the stock significantly recovers to its previous higher level, let's say the stock effectively doubles in value, then I would directly benefit from that substantial recovery and could readily convert the bond into shares at a price of 57 when the stock is back at an impressive 80, thereby making a truly substantial capital gain. But if Fresenius falls back to its previous level and the successes that seemed apparent vanish into thin air and the stock crashes down to 20, then I can say, no, I don't want the shares. I'll just take my money back. And that's a wonderful option. Yes, it does cost me a bit of the performance. If I were 100% sure that the stock would rise to 80, then I would rather just buy the stock. But this way, I can still participate to some extent, but I'm not involved if it goes down. It's a great protective tool that still lets you participate. Very few retail investors know about this instrument.
Very nice. Okay. So what exactly is the fundamental difference between fixed rate bonds and variable rate bonds?
That's a distinction regarding the structure of the bonds. With a fixed coupon, it's like this. I know, for example, that I will receive a coupon of 6% every year, regardless of how interest rates develop until the bond matures. That gives me planning security, but it has the disadvantage that if the interest rate level suddenly rises, I won't receive any more. The framework is set. With a variable rate bond, it's different. There, I receive a premium on top of the base interest rate, for example, the ECB base rate, which is the interest rate of the European Central Bank, the ECB. Most recently, that was at 2.5%. And then, for example, I get a premium of 4%. At first, that means the interest rate is just as high as with another bond that also has 6.5%, right? 2.5 plus 4. But the difference now is when the interest rate level changes, if the interest rate level falls now, then I also receive less interest. But if the interest rate level rises, then I also get more interest. So I am protected in a rising environment. If interest rates rise, I immediately receive more interest as well. And accordingly, I have less price risk regarding the bond during its term because I get higher interest right away. The price fluctuates less during the term than with a bond that has a fixed coupon.
Thank you very much. What are inflation-protected bonds?
With inflation-protected bonds, I receive compensation. It's a bit, let's say, like with variable bonds, it's essentially a premium. But here, it's specifically tied to inflation. If inflation rises, I also receive a higher interest rate. That means my bonds are protected against inflation in this way, and I also have protection against rising inflation.
What exactly does investment grade versus high yield mean in financial terms?
Yes, that refers to the ratings given by the 3 major rating agencies. These agencies and only these, meaning private companies that provide an assessment, define how good a company's creditworthiness is. And now, referring to the most well-known of the 3, namely, AAA is the highest rating. But only a handful of companies and just a few countries in the world have that rating. For example, the USA does not have it. And it goes down from AA to BBB. These companies are also considered to be very creditworthy, and accordingly, they receive an investment grade rating down to BBB minus. And then there are about 10 more credit rating levels below that. If it gets downgraded further, the creditworthiness is lower, and then it's referred to as high yield or junk bond.
Thank you very much. Which bonds are suitable for beginners? What is interesting for beginners? For people who are seriously and genuinely interested in understanding bonds and want to make their very first investments in the bond market, this information is crucial. What do these people need to pay attention to?
Well, there are quite a few points you need to consider. In a way, it presents a similar challenge as the stock market, where you also have to take a whole range of criteria into account. An important point is that you look at how high the interest rate is, what the total return is. And there is a difference between the interest rate that is paid and the yield that I actually receive. Because with regard to the price at which I buy it, they are usually, not always, but mostly issued at 100 and repaid at 100. But if I buy the bond on the open market, then the entire yield framework changes as a result. And here you have to keep in mind, of course, that if I buy bonds with a very high interest rate, then the risk of insolvency is also, at least as assumed by the market, higher. And that's definitely something you need to take into account. I would strongly recommend, if you are buying bonds, to diversify broadly and not rely on a single security. And I would actually recommend buying corporate bonds rather than government bonds in order to have more security in terms of company value and generally also a somewhat higher yield.
What exactly is the fundamental difference between bond exchange traded funds, ETFs, and a carefully constructed bond portfolio that you have personally put together for a complete beginner? So any beginner investor might reasonably say to themselves, yeah, I'll just simply buy a bond ETF, because that way I absolutely won't have any significant problems or complications. That way I'm involved everywhere. Or I go to Helge and have a tailor-made bond portfolio put together for me, where I can also combine stocks if I want and so on. But what is the difference between a bond ETF and a bond portfolio that's tailor-made by you, Helge? What's the difference there? What's the distinction?
So an ETF is a fund that tracks an index, and generally, because it is not actively but passively managed, it has lower fees. For equity ETFs that track stock indices, it's usually the case that the stock with the highest market capitalization also has the highest percentage weighting in the ETF. It's no different with bonds. That means the company with the highest level of debt also has the highest percentage in the ETF. However, we believe that this isn't necessarily always the best benchmark. So if a company has the highest market capitalization, investors generally view that positively. That's very much driven by the market. A stock has a high market capitalization because investors find it particularly attractive and are willing to grant it that high market cap. With ETF, however, high levels of debt are not a reflection of the market's assessment, but simply a matter of who is borrowing the most money. And that's not necessarily always the best decision-making indicator. And in our view, it leads to many ETFs not delivering such attractive performance. However, as an entry point, it is certainly an option one can consider. The other important factor is if I have an individual portfolio with bonds, I can take advantage of a key benefit. Namely, if I have an individual bond, I have the advantage that the bond matures. It matures and I get my money back first. If I have a maturity of 3 years, then after 3 years, the crucial question arises, has the company not gone bankrupt? Will I get my money back? With an ETF, it's different. There, a bond is automatically replaced by another one. It just keeps going. That's why I'm also more exposed to market fluctuations and I don't have the advantage of maturity and the fact that I get my money back first.
Thank you very much, Helge. So if you're interested in bonds, if you want to invest in bonds and learn more about them, give me a call. I will arrange an appointment with Helge. We will meet with you and discuss investment opportunities in bonds. I believe that the current situation in particular offers many interesting opportunities to invest very successfully in bonds. And with Helge's help, I have to say, I've built up a portfolio over several years now, and I must say I am very, very satisfied. I would even say I am more satisfied than some investors who have been dealing in stocks. So I operate well. He operates for me. He selects a mix of stocks and bonds. And I have to say, I am very satisfied. If you're interested, give me a call or send me an email at contact@swiss-banking-lawyers.com. Thank you for your time, and I hope to see you again on my channel. I wish you a wonderful day. Be wealthy and stay wealthy.